Americans held $10.1 trillion in 401k plans as of December 31st, 2025. Total U.S. retirement assets were $49.1 trillion, the highest number in history. And in the same quarter that record was set, a record 4.18 million Americans turned 65, more than 11,400 people per day. Demographers call this peak 6.5, and elevated levels continue through at least 2027. $49 trillion, 11,000 people per day hitting the exit button, a market more concentrated than the dot-com bubble. And a withdrawal rate rule that was calculated in 1994 and has not been updated in most people's financial plans since. This is not the same recession setup as 2008. It is structurally different in 4 ways that matter, and I'm going to show you all of them with math you can run on your own portfolio. Here's what I'm going to explain today. The retirement system worked reasonably well when recessions hit during the accumulation phase. You lose some money on paper, you keep contributing, you buy shares cheaper, the market recovers, and you come out ahead. That playbook is completely useless. It actually flips into a negative the moment you switch from contributing to withdrawing. And right now, for the first time in American history, we have $49 trillion in retirement assets sitting on top of a historically concentrated market at elevated valuations, while the single biggest wave of simultaneous retirees in US history tries to pull money out of it at the same time. I'm going to show you the 4 specific mechanisms that make the next recession more dangerous for retirement accounts than 2008 was. And I'm going to show you with specific dollar amounts why the people closest to retirement are the most exposed and have no idea. Think of your retirement portfolio like an escalator. When you're working and contributing, the escalator is going up. The market drops, useful. You get more stairs for your dollar. The escalator pulls you higher when it recovers. That's how compounding works. But the day you retire and start withdrawing, you are now riding the escalator down. And the problem with riding it down is that every step you take pulls shares out of the pile permanently. A drop on the way down doesn't temporarily lower your balance the same way. It forces you to sell more shares to cover the same expense. Those shares are gone forever. They can't compound back. The escalator is always descending. And the design flaw in the whole system is this. You're sharing that escalator with 11,000 other people getting on every single day. When everyone hits the down button at once, the escalator picks up speed in one direction only. I'm going to come back to this escalator throughout the video because it explains everything. In a few minutes, I'm going to show you something about how the S&P 500 is actually constructed right now that should genuinely alarm anyone with an index fund in their retirement account. But first, let me show you why the scale of this retirement wave makes every other market risk worse than it would be in isolation. Between 2024 and 2030, an estimated 30.4 million boomers will reach traditional retirement age. 30 million people going from net buyers of stocks to net sellers. That is a structural shift in market flows that has no historical precedent. And here's the piece of context that reframes everything else. In 2008, when the last truly severe recession hammered retirement accounts, the people getting hurt hardest were cushioned by a different infrastructure. When people in the peak 65 generation entered the labor market in 1980, approximately 60% of private sector workers relied on the protected income offered through a pension plan as their only retirement account, compared to just 4% in 2020. You read that correctly. 60% had pensions. Now it's 4%. The entire retirement system pivoted from the company guarantees you an income for life regardless of what the market does to here's a bucket, good luck filling it, and by the way, you now absorb the investment risk personally. The 401k was invented in 1978 as a supplemental savings vehicle for highly compensated executives. It was not designed to be the primary retirement safety net for 160 million Americans, but here we are. There is a man I want you to keep in the back of your mind throughout this video. Call him Dave. Dave is 58 years old. He spent 30 years in middle management at a mid-sized manufacturing company in Ohio. He did everything the brochures told him to do. He maxed his 401k contributions for 12 years straight. He moved to a target date fund when his HR rep told him to. His balance hit $400,000 at the end of 2024, and he felt for the first time in his adult life, like he was genuinely going to be okay. Dave is not a character. Dave is the median. I'll come back to him. Stay with me, because this next part completely reframes how you should think about diversification inside a recession. You think the problem is that the market might fall. That is not the real problem. The real problem is what falls, and how much of your so-called diversified index fund is actually one very concentrated bet right now. At the end of December 2025, the top 10 holdings of the S&P 500 represent 40% of the index's total weight. 40%, 10 stocks out of 500. The 10 largest companies grew from 22% of the S&P 500 in 2020 to just shy of 40% today. It has almost doubled in 5 years. Today's concentration is well above the 27% peak reached during the technology bubble of 1999 through 2000. We are literally more concentrated than the dot-com bubble. And you own all of it in your 401k. Right now, if you're in a standard S&P 500 index fund, heading into 2026, the so-called Magnificent Seven stocks still make up around a third of the S&P 500's market capitalization, despite an uneven performance in 2025. That concentration risk is starting to unnerve some advisors who are adjusting their portfolios to protect against it. If you have $200,000 in a standard S&P 500 index fund, roughly $70,000 of that is in 7 companies: Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, Tesla. That feels fine when they're going up. In 2025, roughly 42% of the S&P 500's total return came from the Magnificent Seven. That kind of concentration can mask what's happening underneath the surface, and it can amplify drawdowns if leadership narrows further or sentiment shifts. Let me tell you a story about what happens when a concentrated thesis unwinds. Back in the late 90s, a fund manager named Alberto Villar ran Amerindo Technology Fund. It was the best performing fund in America for 3 consecutive years. His clients thought they were diversified because they owned a fund. It had dozens of holdings spread across many companies, but they were all correlated, all riding the same wave of internet infrastructure optimism, all tied to the same narrative about how bandwidth demand would grow forever and the companies supplying it would compound indefinitely. When that narrative broke in 2000, the fund lost 85% of its value in 3 years. Not because every individual company failed, but because when the tide goes out on a concentrated narrative, everything goes at once. The $500 stock and the $20 stock both go to roughly the same place, dramatically lower. Deloitte's downside scenario assumes that AI investment gets overdone, leading to a sharp pullback in business spending in 2027 as companies reassess potential demand for related products. Real business investment is expected to decline by 3.2% in 2027. Companies are increasingly tapping financial markets to fund AI-related investments, which could create negative spillover effects should they be unable to repay their debt. I'm not predicting an AI bubble. I'm describing the mechanism. If the narrative that is currently holding 40% of your retirement account's market cap aloft were to face a credibility challenge, the escalator moves fast. At the end of the S&P 500's last quarter of 2025, the index was trading at 21.6 times its expected earnings. That's higher than the 5-year average of 20 times earnings and the 10-year average of 18.8. Not a bubble, but an elevated starting point. And elevated starting points mean that when a recession compresses earnings multiples, which they always do, the drop is not neutral. You are starting from a height. The fall covers more distance. By the way, hit subscribe if you like this content. Otherwise, YouTube's algorithm may never show you my videos again. Knowing these numbers and building a system around them are 2 very different things. I've been sitting on this data for a while, and knowing it did not change anything until I actually structured a framework around it. So I built a digital book called The Exit Code. It's 8 chapters of pure research. No filler, no motivational filler chapters, no vague advice. 50 years of actual retirement data distilled into a mathematical framework for turning maybe someday into a specific date. 2 things in the book connect directly to what I'm describing in this video. The first is what I call the 4% trap. The reason the most widely cited retirement withdrawal rule was built on assumptions that no longer apply in 2026, and the dynamic withdrawal method that replaces it, which adjusts based on market conditions so you never end up in the forced selling spiral we're going to talk about in a moment. The second is the lazy portfolio, a historically back-tested allocation that has outperformed most active managers over 30-year windows with less volatility without requiring you to monitor a financial terminal. You can get it for less than 1 hour with a mediocre financial advisor through the link in the description. Every year you delay, the math of compounding runs against you. That's not urgency. That is just arithmetic. Now, here's the thing about sequence of returns risk that most financial media describes completely wrong. They call it a risk as in something that might happen. It's not a risk. It is a mathematical certainty that plays out differently depending on when it hits. And the gap it creates cannot be undone once it has happened. Let me give you the actual numbers. Picture two people retiring with $2 million each. They both pull $80,000 a year, adjusted for inflation. They both earn an average of 5% per year over 20 years. The math says they should end up in the same place. They don't. One finishes with roughly $2.4 million in the bank. The other finishes about $1.7 million less, dangerously close to running out. Same portfolio, same withdrawals, same average return. The only difference is the order in which the returns showed up. This is not a hypothetical from a textbook. The S&P 500 returned roughly 17.9% in 2025 on a total return basis, but the path was anything but smooth. The index dropped nearly 19% in the first half of 2025 before recovering to finish well in the green. Anyone who retired in March of 2025 and started drawing income immediately lived the bad version of that story in real time. They sold shares at the bottom of the dip in March and April. Those shares recovered, but they had already sold them to pay rent. The recovery happened to someone else's portfolio. Think of it this way. You're filling a bathtub with a faucet while a drain at the bottom slowly pulls water out. When the tub is full, the drain's effect is small relative to the volume. When someone suddenly opens the drain wider, that's a market drop. The water level falls faster, but you still need the same amount of water for your bath every single day. So you take from the reduced volume. The drain doesn't close. The pool gets smaller. Each subsequent withdrawal takes a proportionally larger bite. You need a dramatically higher return to recover, not just the same return you would have needed before the drain opened. And when the faucet runs better again, when markets recover, you're working with less water than everyone who didn't have to drain during the crisis. Imagine a prolonged market downturn that depletes your savings in the years right around when you retire, forcing you to sell stock at a loss to meet living expenses. Even if the market bounces back, great returns on a shrunken pile of investments cannot make you whole. Retirement dreams are kneecapped from the get-go. That possibility is called sequence of return risk, and it can hit in a danger zone stretching from the 5 years before retirement to the 5 years after. The 5 years before and 5 years after. Right now, more people are simultaneously in that window than at any other point in American history. And this creates a sequence of returns risk for those retiring in 2026, where a market downturn in the first few years of retirement can permanently deplete a nest egg that hasn't had sufficient time to grow. Permanently. That word is doing a lot of work. In the accumulation phase, permanent loss is nearly a fiction. Keep contributing. Time heals the wound. The market recovers. In the distribution phase, permanent is accurate. You sold those shares at the bottom. They belong to someone else now. The recovery compounded in their account, not yours. And here is the reversal that most people have not priced into their planning. You think the problem is the market going down. The actual problem is that a market going down while you are forced to withdraw from it creates a self-reinforcing mechanism that locks in losses that no amount of patience will fix. 401k participants on the verge of retirement, ages 56 to 65, had average changes during the 2008 crisis that varied between a positive 1% for short tenure individuals to more than a 25% loss for those with long tenure. The people hurt worst in 2008 were the ones closest to the exit. But those people still had jobs. They absorbed the paper loss while still contributing. The structural difference today is that the people absorbing a potential recession hit are not near retirees with income. Millions of them are actual retirees without any income other than their portfolio and Social Security. They cannot wait it out. They do not have the option of staying the course, because staying the course for someone in mandatory distribution mode means selling equities at whatever price the market offers today to pay next month's expenses. Often, retirees find themselves stopping earlier than planned due to health shifts or caregiving responsibilities. Dave, the man I mentioned earlier, is 58. He planned to retire at 63. But there's a 58% probability, according to research I cover in detail in the exit code, that workers over 50 who leave their jobs voluntarily or involuntarily will never return to full-time employment at equivalent income. A recession that hits his employer might not fire Dave outright. It will restructure. It will offer a package. And Dave, at 58, with $400,000 in his 401k and 2 teenagers still at home, will have to decide whether to take the package or gamble on finding equivalent work in a recession labor market. Most Daves take the package, and now they're in withdrawal mode at 58, not 63. They just added 5 years to the distribution phase without adding a single dollar to the accumulation pile. Now, let's talk about the 4% trap. This is where the standard financial advice fails at the exact moment you need it most. For 30 years, the central rule of retirement planning has been the 4% rule. It was developed in 1994 by a financial planner named Bill Bengen. The concept is elegant. Withdraw 4% of your portfolio in year 1, adjust that dollar amount for inflation every subsequent year, and historically, you would never run out of money over any 30-year period covered by the data. It became the cornerstone of every retirement calculator, every advisor meeting, every HR onboarding brochure. 4%. That's the number. Researcher Bill Bengen developed that rule of thumb back in 1994. In 2021, against a backdrop of historically low bond yields and high equity valuations, Morningstar decided to re-evaluate Bengen's work. Their inaugural research concluded that 3.3% was a more realistic estimate of a safe starting withdrawal rate in 2021, assuming a balanced portfolio, fixed real withdrawals over a 30-year retirement, and a 90% probability of success. 3.3, not 4. On a $500,000 portfolio, 4% is $20,000 per year. 3.3% is $16,500 per year. That $3,500 annual gap is the difference between a comfortable and an austere retirement for millions of people. And it compounds in the wrong direction the longer you live. Now, Morningstar updated the number again. Morningstar analyzes the 4% rule every year based on market conditions and says that for the typical person retiring in 2026, the safest starting withdrawal rate is actually 3.9%, not 4%. 3.9, still not 4. And even 3.9 assumes things that are increasingly not true in 2026. It assumes your portfolio is invested pretty evenly between stocks and bonds. It assumes bond interest rates are decent. Most people in standard target date funds are heavier on equities than they think, especially after the multi-year bull run that inflated equity valuations and shifted allocations further towards stocks. And here is the compounding problem on top of the compounding problem. Inflation was running at 3.8% as of April 2026. When you're withdrawing 4% of a portfolio that is also shrinking by 3.8% in real terms due to inflation, your nominal withdrawals compound upward while your portfolio's real purchasing power erodes. In a high inflation environment, withdrawing more at the start of retirement to keep pace, particularly when the market is down, can throw retirement planning off track. Someone who started withdrawing $100,000 a year would be taking out $114,490 in year 3 after 2 years of 7% inflation. That's hard to sustain, as you'll continue to build off those higher than expected withdrawal rates. This is the 70s scenario, and most people under 45 have no intuition for it because they've never lived through it. A couple who retired in 1966 with a $250,000 portfolio equivalent to roughly $1.8 million in today's dollars and followed the 4% rule did not survive the 1970s. Inflation ran above 9% for multiple consecutive years. Their nominal withdrawal requirements inflated accordingly. Their equity portfolio tanked during the stagflation bear market. Their bonds lost value as rates spiked. By the late 70s, the portfolio was gone. Not because of below average long-term returns, because of sequenced risk during a period where inflation and poor equity performance hit simultaneously. And the structural setup today has meaningful similarities. Goldman Sachs projects that the current tariff regime will raise inflation by 1% between the second half of 2025 and the first half of 2026 relative to its counterfactual path. That is on top of inflation that was already running above the Fed's target. Oil prices have jumped. Energy markets have added another layer of strain in 2026. Gasoline prices have jumped since the US. And Israel conflict with Iran due to disruptions around the Strait of Hormuz, a key global cargo shipping route for oil. These are not catastrophic numbers in isolation. They are a compounding setup. Here's what this means in concrete terms for a real portfolio. Let me give you Jennifer's case. Jennifer is 59. She is a mid-level manager at a healthcare company, planning to retire at 63. She has been diligent. Her 401k balance at the end of 2025 was $480,000. She has no debt. She plans to claim Social Security at 67, which will provide approximately $22,000 per year. Her expected annual spending in retirement is $64,000, covering housing, healthcare before Medicare kicks in, food, modest travel, and an emergency buffer. Scenario 1. The market cooperates in her first 3 years. Portfolio compounds at historical averages. She withdraws approximately $20,000 per year before Social Security begins, roughly 4.2%. By 67, her balance has grown to approximately $510,000. At that point, she only needs about $42,000 from her portfolio annually, supplemented by Social Security. The math works. Probability of running out of money before 85 is around 15%. Scenario 2. A recession hits in year 2 of her retirement. The S&P 500 drops 30%. Her $480,000 balance becomes $336,000. She still needs $20,000 that year. That $20,000 represents nearly 6% of the post-crash balance, not 4.2%. She sells shares at the worst time. Those shares are gone. In year 3, the market recovers 15%. 15% on the $316,000 remaining after her withdrawal is $47,000. She is at $363,000. She is permanently impaired by roughly $117,000, simply because the recession hit in year 2 rather than year 7. The market did not perform worse over the 20-year window. The sequence did. That $117,000 gap, compounding at a modest 6% over 20 years, represents approximately $375,000 in lost terminal wealth. Jennifer doesn't retire in poverty. She retires stressed. She cuts spending. She delays a medical procedure. She doesn't visit her grandchildren as often as she planned. None of that shows up in a portfolio projection. Meanwhile, Jennifer's advisor showed her an average return projection. The average return in scenario 2 was fine. The sequence was not in the slide deck. Now here is something the aggregate retirement data is already signaling before any recession has officially started. 6% of workers in Fidelity's plans took a hardship withdrawal in 2025, up from 4.8% in 2024 and roughly 2% before the pandemic. It marks the 6th straight annual increase since 2018, when Congress loosened hardship rules. 6% may not sound alarming, but the trend line is unmistakable. The median hardship withdrawal was just $1,900, with avoiding foreclosure or eviction and covering medical costs among the top reasons. These are not irresponsible people raiding their retirement for a vacation. These are people whose financial margin has collapsed to the point where the only available asset is the retirement account, and that account comes with a 10% penalty and ordinary income taxes on top. A $1,900 hardship withdrawal from a 401k for someone in the 22% bracket cost them approximately $2,500 in real terms, permanently removes the compounding on that money, and contributes nothing to the crisis that triggered it. More than 1 in 4 25.9% of Gen X workers has an outstanding 401k loan, which is greater than the overall percentage of workers with a loan outstanding in Q3 2025. Gen X, the generation behind the boomers, 45 to 60-year-olds, their prime accumulation years, more than 1 in 4 of them has borrowed against their future self. That loan reduces the compounding base, removes shares from the market during the loan period, meaning they miss any recovery while the loan is outstanding, and if the borrower loses their job, the loan becomes a distribution, taxable immediately and subject to penalty. A $10,000 loan that converts to a distribution costs roughly $15,000 in taxes and penalties for someone in the 24% bracket. The 401k is quietly becoming the emergency fund of last resort for a generation that has no other liquid assets. That is a systemic fragility, not an individual failure. There is a difference between a system under stress and a system at breaking point. We are in the former. The question is, what happens when a recession lands on a system already showing those fractures? The probability of a recession, defined as 4-quarter output growth falling below negative 1.0% over the next 4 quarters, is 35.8%. According to the New York Fed's DSGE model, as of March 2026, JP. Morgan Research placed the probability at 40% as recently as earlier this year before partially walking it back following tariff de-escalation. 35 to 40%. That is approximately the same probability as rolling a die and landing on 1 or 2. The base case is not recession. But the base case also was not recession in August of 2007, when the first cracks in the mortgage-backed security market started appearing. The base case was fine right up until it wasn't. The underlying economic environment of 2025 was fraught with uncertainty, characterized by a new and sweeping tariff regime, a deteriorating budget trajectory, consumer anxiety around cost of living, and concerns about an artificial intelligence bubble. Consumer spending cooled more than expected, residential investment declined, and exports saw a notable drop due to President Donald Trump's tariff policies. Government spending and investment also fell sharply during periods of shutdown. These are not recession signals in isolation, but they are the kindling for one, and here is the structural difference that makes all of this more dangerous than 2008 for retirement accounts specifically. Estimates from the EBRI and ICI database show that many participants near retirement had exceptionally high equity exposure. Nearly 1 in 4 between ages 56 and 65 had more than 90% of their account balances in equities at year-end 2007. Those people were devastated on paper, and then most of them recovered because they still had income. The recession hit their balance sheet, not their cash flow. Today's retirees have the same or higher equity concentration. Average retirement balances can shift $10,000 to $50,000 in a week, but they no longer have income. They are in mandatory distribution. They cannot wait. The escalator is going down and they are on it. Imagine you are a financial advisor. Your client calls you in the middle of a 30% market drop. He has just retired. He needs $20,000 for quarterly expenses. His portfolio is down and he needs to liquidate. You cannot tell him to wait. He cannot wait. You sell, you lock in the loss, you pray the market recovers fast enough that the subsequent withdrawals don't compound the problem. That is not bad advice. That is the structural design of the 401k system applied to the distribution phase of life, working exactly as designed, producing exactly this result. The same financial industry that spent 40 years evangelizing the 401k as the solution to America's retirement security problem now charges you 1% of your assets annually to manage the exact same concentration risk and sequence of returns exposure they never explained when you signed up on a $400,000 portfolio that is $4,000 per year over 20 years, assuming 6% annual returns. That 1% annual fee charged every year on your growing balance costs you approximately $140,000 in lost compounding. $140,000. For asset allocation advice that rarely deviates from a target date fund on autopilot, there's a famous story about a chess master who once said, "The outcome of most games is decided not by the brilliant move, but by the avoidable mistake." Retirement finance works the same way. Most people who struggle in retirement are not missing a sophisticated strategy. They are making 3 specific avoidable mistakes, and those mistakes are only visible if you run the stress test in advance. Here are 3 things you can do right now, calibrated specifically to this setup, not generic retirement advice. 1. Build a 2-year buffer before you need it. Having 2 to 3 years of expenses in stable investments, bonds, stable value funds, cash prevents forced selling during a crash. 2 years, liquid, outside your equity portfolio. This is not market timing. It is insurance against sequence of returns risk. The insurance is only cheap before the event. The time to buy flood insurance is not while the water is rising. If you are within 5 years of your planned retirement date, this is not optional. This is the single highest leverage move you can make right now. 2, recalculate your withdrawal rate with the honest, forward-looking number, not 4%, not what your calculator defaulted to in 2015. In December 2025, Morningstar's research announced 3.9% as the optimal rate for those retiring in 2026, for a 90% probability of success over 30 years. If you plan to use a flexible withdrawal approach, taking less in bad years and more in good years, you can sustain a higher starting rate. But you must model the worst case sequence explicitly. Run a scenario where your portfolio drops 30% in year 2 of retirement and stays down for 3 years. If your withdrawal plan survives that scenario without going permanently below a sustainable level, you're probably positioned correctly. If it doesn't, you are underestimating your actual risk. 3, know your sequence window and reposition inside it. The danger zone for sequence of returns risk stretches from the 5 years before retirement to the 5 years after. If you are inside that window right now, your portfolio should not be positioned the way it was during peak accumulation. Not because you should move to cash. Cash creates inflation, erosion risk, and opportunity cost over 20 years of retirement. But because your concentration in a market where 40% of the S&P 500's weight sits in 10 stocks creates a synchronized drawdown risk that standard diversification does not protect against. An equal weight index fund, a dividend-oriented allocation, some international exposure, these are not exotic instruments. They are the structural difference between a portfolio that survives a concentrated sell-off and one that doesn't. Dave, by the way, made one change that I want to close with. He did not become a sophisticated macro trader. He did not move to gold. He did not liquidate his 401k and buy rental properties. He did one thing. He ran the bad scenario. He opened a spreadsheet. It assumed his portfolio dropped 30% in 2028, the year he plans to retire, and calculated how many shares he would have to sell at that price to cover his first year of expenses. He looked at the number, and then he started building a cash buffer. 18 months of expenses in a high-yield savings account. Not in the stock market, not in his 401k, just liquid, boring, available money. The kind of money that means you never have to ride the escalator down at the worst possible speed. Lazy investing built more fortune than crypto memes. And that closing line is not motivational, it's descriptive. The investors who built durable wealth across the cycles did it with boring portfolios, honest stress tests, and unglamorous buffers. The risk in 2026 is not that you're too passive. The risk is that the market feels calm enough right now to make boring look unnecessary, right up until the escalator picks up speed and you realize you're the one sharing it with 11,000 people pressing the down button every single